Inflation is back in the spotlight as investors reduce their bets on Fed rate cuts. Welcome to Market Insight. I'm Elena Casas. Consumer price inflation for October is due out tomorrow, with the headline number seen rising on last month to an estimated 2.6% year-on-year from 2.2%. That comes as markets are already pricing in fewer Federal Reserve rate cuts for 2025. The chance of a December cut is still seen at 69%, but forecasts for next year are up in the air as traders try to predict the possible inflationary impact of Donald Trump's policies. Well, joining me now to talk about all that is Saidel-Baker, economist at ITR Economics. Lauren, hello. Inflation then is already seen coming in stronger than October than the previous month. What's underpinning that?
Yeah, so we want to be careful to point out that 1 month of data does not make a trend. We are still seeing general disinflation. Again, that is disinflation, not deflation. Prices still rising, and they are rising at a faster clip than that Fed's target 2% rate. However, the general trend has been one of easing from that very high 2022 peak in the CPI. So things moving in the right direction, just not in such a linear path as we had seen in recent months.
And that could leave the Fed in a tricky position, couldn't it? We do, as I said, still expect a December cut, but that will be the last meeting before Donald Trump's new administration takes office. And after that, the outlook for policy has become harder to predict, hasn't it?
Absolutely. And again, the Fed is not a political entity. They are nonpartisan. So they're really looking at the impact of policies, not politics here. The types of things that could bring back inflation a little bit more strongly in 2025, that would be increased tariffs potentially under the Trump administration. But I want to be careful to point out that general inflation, we at ITR Economics had seen it really resurging in 2025, regardless of those tariff policies. We're seeing a lot of demand coming back in 2025, and this year it's been taken a little bit more of a plateau position. So as we get that demand pull on prices, as we do get a resurgence in a lot of fundamental issues like the velocity of money, the money supply, we're starting to see some of those factors align for really increase in inflation by next year.
How much should market watchers be worried, though, about how much more that inflation could rise in the case of higher tariffs in particular?
Absolutely. At this point, I think we should be watching. I don't think we should be worried. Again, we are not forecasting inflation to get to those very high levels that we saw just a couple of years ago. That 2022 peak on the CPI was close to 9%. Now, that was really exacerbated by a lot of things like the supply chain issues, all of those ripple effects from COVID that you remember so well. We don't have that same seizing up of markets, but we do have a lot of these more regular kind of fundamental drivers of higher prices going forward. And it's important to remember that inflation typically does run a little bit higher than we have seen in that pre-pandemic decade. That post-Great Recession right up until the pre-pandemic timeframe, we very rarely saw inflation even reach that 2% target rate. So looking for a more low to even mid-single-digit range of inflation, that should be expected on the broad historic scale.
And how are you expecting the Fed to handle that next year?
They're watching very closely. Inflation got away from them one time. They thought it would be transitory and really regretted that, it seems, in hindsight. So they don't want to see inflation get away from them again. Now, that is all balanced by the labor market side of their dual mandate, which at this point, the labor market, while showing some signs of loosening up, is still very tight, really historically tight. So we don't see signs of fundamental cracks forming in the labor market. We do have a little bit of distorted data coming on the wakes of a few major hurricanes, of some recent strikes. So it will take a few more months of labor results to really show us where that trajectory has bottomed out.
The other side of Trump's promised policies, of course, involve tax cuts that have economists implying a much higher US deficit. How much should that be a concern, do you think? We see already in the bond markets that yields are rising again on the prospect of that.
Yes, long term, we are very worried about the deficit, the rising debt levels. This has been a long term concern here at ITR Economics. Now, I really want to point out this is a longer term outlook. I think in the next few years, even the 4 years of Trump's upcoming term, we probably won't reach the end of that road. We can keep kicking the can down the road for a while longer, but eventually we'll have to pay the piper, and that is a fundamental concern of ours in the broader term.
Lauren Saidel-Baker of ITR Economics, thank you so much for joining us. And that's Market Insight. Don't forget, you can watch more videos on Reuters.com.